I'm pretty comfortable that the next cycle peak, which would be, 29, and it would be, September 29, somewhere between 6 and 700K. The Genius Act, very good for Ethereum because it basically said if you're not Tether or USDC, you don't count. So the Genius Act, I will argue, isn't really a good thing because now part of that is they can do what they just did. They can go to Tether's office and say, we're seizing those coins from those Iranian wallets. That's not the decentralization we all envisioned, right? And the fact that you're going to, if they outlaw self-custody in, the Clarity Act and say you have to put it at Coinbase or, Kraken or someplace like that, and then we can go in and take it, that's less good.
Mark Yusko's framework for understanding digital assets begins from a deceptively simple place: math. Not hype, not ideology, not tribal belief, but arithmetic, incentives, and human behavior expressed through numbers. In a market increasingly dominated by narratives, Yusko's approach is deliberately unromantic. Prices are not prophecies, cycles are not opinions. They are the emergent result of structure, supply constraints, leverage, and psychology repeating itself across time. Yusko's first valuation anchor for Bitcoin is gold, not total gold, but monetary gold. Roughly half of gold's market value exists as jewelry, art, and industrial use. The other half represents monetary reserves, the bars held by central banks and sovereign institutions as neutral collateral. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So to me, it's just math. And so, to me, there's two ways I approach it. So one is Bitcoin gold equivalence, right? Which is, I do believe someday the monetary value of gold, which is about half of the total value, because the other half is jewelry and chalices and art and stuff. But the monetary value, the bricks that are in central banks, et cetera, is about half of the value of gold. So, way back when we were 20 trillion of gold, I said 10 trillion of Bitcoin value. So, that was where I got the directionality for the 100,000 to, 120, 140. The other piece of it is every halving, we add a zero. So we increase the total market cap 10x. Now, does that mean it has to happen every time? No, but it has, from 10 to 100, from 100 to 1,000, from 1,000 to 10,000, 10,000 to 100,000. But that's the fair value. But inevitably, we go above fair value. So when it was at 10,000, we got to 20, and at 100,000, I thought, we'd get not all the way to 200, but 150 maybe. I think that was the number in my presentation last January. And we got to 126. Okay, so call me a liar. Now, at least I wasn't the guy calling for 2 million. There are plenty of those. But that's a long-winded way of saying next cycle, if we added a zero, fair value would go to 1 million. People, oh my God, Mark, that's so ridiculous. I'm like, well, okay, let's back into it. So gold market cap increased, at one point it hit 37. I think it's now back at, 32, 33. Let's just round it to 30. Let's say it settles in at 30. So that's 15 trillion. So 15 trillion. Gold equivalents. If we got Bitcoin at 1.7, right? 1.6. So let's just, again, use round numbers. Let's say it's 10 times from here. So 10 times 75 would be 750. It's a little light. I'm okay with that. So I'm I'm pretty comfortable that the next cycle peak, which would be, 29, and it would be, September 29, somewhere between 6 and 700K. The Genius Act, very good for Ethereum, because it basically said, if you're not Tether or USDC, you don't count. It's not exactly that, but they're the preferred providers, and and you can see it in all the data, right? All the data is the Ethereum growth continues, and everyone else is playing catch up. It doesn't mean there won't be stable coins on other chains. So the Genius Act, I will argue, isn't really a good thing, because now part of that is they can do what they just did. They can go to Tether's office and say, we're seizing those coins from those Iranian wallets. That's not the decentralization we all envisioned, right? And the fact that you're going to, if they outlaw self-custody in, the Clarity Act, and say you have to put it at Coinbase or, Kraken or someplace like that, and then we can go in and take it, that's less good. So that's a whole different guy. So I'm an okay supporter of the Genius Act. I don't love it, but I don't hate it. I hate the current market structure Clarity Act. And, the fact that Brian Armstrong was labeled public enemy #1 last weekend by Wall Street means that we should all be very afraid of the bill as it's currently passed. And, I'm probably going to have, the black hat show up when I say this, but everyone thinks the president is our friend, meaning our collective friend in crypto. He's not. He's just not. He is definitely not. He has a whole different agenda, and Besant and all those guys are included in it. And it is Cantor and Tether, and there's some clandestine stuff, but it's all about preserving the dollar hegemony and preventing Xi's vision of the world. And the real problem is, in the old days, right, you secured the currency through military force. The future, again, my belief, and I think China figured this out, is the future you secure it with chips, not ships. Which is, we have this big DRAM problem and NAND problem and SanDisk going like this. So who this morning announced that they're going to start producing, memory chips to Chinese companies? Interesting. Now, are people going to buy Chinese memory? Are they going to worry about bugs and well, I don't know. We use TikTok every day. Everybody seems fine with that. So I think there's a more sinister agenda going on than people think. And the Clarity Act as written is a non-starter, because it takes us down the path of CBDCs and centralization and control and the digital gulag that I want to avoid. So hopefully it'll get changed. Hopefully Brian fights the good fight. But I still believe Ethereum, despite the fact that it's more expensive and slower than Solana and others, it wins because it has more developers, it has more activity, it has more tech debt. There's more things already built on it. And here's the interesting thing. If you just looked at who's spending all the money, you would think XRP has this thing locked up, because, he's been trying to buy his way in to being the base layer for, the old system, but no one seems to be adopting it. And Chainlink seems to quietly be, making roads. I mean, New York Stock Exchange didn't say the word Chainlink, but they kind of implied it for RWA. But despite all the talk, if I look at volume on Ethereum. And the other thing is the gas prices on Ethereum have dropped dramatically, which means it could function. And that's just the way scaling works, right? When you have a small system, you got a fixed amount of gas, it's a high percentage. If the scaling powers it, that percentage falls. So that's a long-winded way of saying I think there's a better case for Ethereum than the others. I worry there's a curveball coming, and maybe it's an XRP thing, and he's doing more behind the scenes than I know. I worry that there's a CBDC version coming where they just say, you know what, you can't use Tether, you can't use USDC, and if you don't use the government, we're going to put you in jail. Kind of like the 33 Act with gold. I hope it doesn't go that way, but I just have a little unease in the back of my brain that something like that's going on.
Despite being slower and more expensive than competitors like Solana, Ethereum retains decisive advantages. It has more developers, more deployed capital, more applications, and more embedded technical debt. In software ecosystems, technical debt is not weakness, it is gravity.
I don't know why people feel so strongly that the cycle has to be over. Like, look, humans are going to human. And one of the interesting things about digital assets, Bitcoin, Ethereum, Solana, all the way down through the altcoins, is they're still dominated by humans. I mean, there's more algo activity than there used to be, but they're still dominated by humans, which is why cycles exist, right? Humans, I would say, do two things really well. We buy what we wish we would have bought, and we sell what we're about to need. And we do it over and over and over again. And it doesn't matter how many times you make the mistake, humans are going to human. And so what does happen as markets become less human and more robotic, take equities. Equities now, 60+% of the money is passive index. It's unthinking. It's dumb, meaning rule-based. Let's a simple example. So if you run an index, and it's an index of home builders, right? And home builders normally trade at, pick a number, 7 times earnings, 8 times earnings, because it's a cyclical business. And then this company, WeWork, says, oh, we're going to reinvent real estate, and we're a technology company, so we should trade at 40 times. And it comes out, and it's a real estate company, so it has to go on the real estate index. The index doesn't get to think, well, that's stupid. I'm not going to pay 40 times for, maybe it could go from 7 to 10 or 10 to 11, but I'm not going to pay 40. You don't get to think. You have to buy the capitalization weighting that it gets included in the index. So when markets stop thinking, they become less volatile, and you've seen the VIX, continue to get compressed in equities, and they become more easily manipulated by the short-term traders. So Ken Griffin gets super rich, while the rest of us, and I love this. Well, I trade for free on Robinhood. Really? Free, right? I mean, you're missing on execution because someone's got to get paid. But that process of technocracy, make up a word, does a couple things. So in the olden days, there was something called commodity trading advisors. And they're in the pits up in Chicago, and they noticed these patterns, right? That humans were going to human. And so they came up with these machines, these models, to take the emotion out of investing. In fact, the first firm I ever worked for, we had a brown coffee mug, ugly color, and it said, invest without emotion. That was our tagline, based in Chicago. And it did really well because if the market's emotional and you can run rules, you can scalp the emotions. Well, if you take the emotions out, it's just who has the fastest robots. And so the people who have the biggest machines closest to the exchange won that game. And the CTA's alpha went from way up here to way down here. In digital assets, curiously, the alpha-driven I mean, the CTA-driven strategies are still generating thousands of basis points of alpha because they're scalping the emotion. Like when I said, back in whenever it was, September, October, that unfortunately I really thought we're going into crypto winter. I mean, the vitriol was unbelievable. And if I just had a bot just saying, well, it's time to short, I would have made a lot more money than, what I did is I got in debates with humans. And, if somebody's really intelligent and has a good argument, they can convince you that, no, it's different this time, which it never is. And I should have just listened to the bot.
Mark Yusko's message is neither utopian nor cynical. It is disciplined. Bitcoin's valuation is grounded in monetary math. Ethereum's dominance is rooted in network reality. Regulation is a double-edged sword. Power seeks control. Humans repeat themselves. Nothing fundamental has changed, and that is precisely why the cycle is not over. Winter will pass, excess will burn off, fair value will rise again, and those who understand the math, rather than the noise, will still be standing when the next expansion begins.